Good morning and welcome to today's morning report with me, Richard Perry, market analyst at Hantech Markets for Friday the 31st of January. Please make sure that you've read the disclaimer at the bottom of our morning report page on our website, as this video is for informational purposes only. Taking from an update on the Asian trading hours, it seemed to be that risk appetite was fairly stabilised overnight, following on from that US GDP number that came in at 3.2%, which was in line with expectations, but certainly shows that this US economic recovery is well on track at the moment. So that was a positive, and also we had out overnight the inflation data for China. You've got a chart here for that, coming up at 1.6% for December, that is, and it certainly shows that Abenomics in the past year has been incredibly beneficial to inflation, actually, in the attempt to get it away from inflation towards that 2% target that the BOJ has got. And that has also helped a bit of sentiment. I mean, in Asian trading, there was obviously Chinese New Year started, celebrations yesterday, and the markets were closed for China, Hong Kong, and South Korea. So volumes were fairly light, actually, in Asia, and markets were fairly flat. But the European handover has been fairly, has actually dropped away at the open in European trading hours, despite the fact that Wall Street had a positive close last night. The trading sentiment early in the European hours is fairly muted, but certainly being the last day of the month, maybe there'll be it's a bit of book closing. So we'll wait and see what happens there. But what we're looking out for today is going to be this Eurozone CPI number that comes at 10 o'clock. The expectation is for a slight improvement, actually, to 0.8% from 0.7, which would certainly help the ECB, as any disappointment in that number, if it came under maybe at 0.7 or even lower, then that would heap even further pressure on the ECB to act, whether it be through monetary policy easing in terms of interest rate cuts, or possibly LTRO, or even quantitative easing full blown. So it's an important number, certainly for the Eurozone, and has an impact on the euro. And the chart of the day that I'm looking at is encompasses both these two inflation figures that I've already spoken about, and that is Euro Japanese yen. Now, this Euro yen chart has had a significant, had a big run up at the end of last year, but has now fallen into this very well defined downtrend channel. And you look at this chart; it continues to use this 120-day moving average almost bang on, and I think that's where it's basically coming back towards. That 120-day moving average is at 136.43 at the moment. The rate currently up in the high 130s, so it looks like there is some further correction to come in this chart. The 21-day moving average has turned down on this, and is actually now being used as the basis of resistance for the rallies and within this downtrend channel. So watch out for that. On an intraday basis, you'll see that continued lower highs and also supports failing, and also certainly in the last couple of days, this the RSI is in negative configuration, consistently below 50. The MACD is consistently below the zero line. You got a little bit of a stochastic buy signal in the last hour or so, and that has resulted in a bit of a rally. So you'd be looking at the resistance at 139.50 and also 139.94. They're the two levels that you'd be looking out for, maybe to use as a sell signal. But certainly I think I'd be using any sort of rally in this Euro Yen chart as a chance to sell, as I think it's coming back towards that 120-day moving average that I spoke about earlier, and that's currently in the mid 130s, 136.43. Anyway, good luck with your trading today. Please make sure that if you get a chance to look at our euro dollar, cable, gold, and dollar yen charts, that would be very good. Might be very helpful for you. But it's Friday, so there's no there's no morning report tomorrow, but I wish you good luck and a happy weekend, and I'll speak to you next week. Thank you.